Hello, and welcome back to Trust Talk, where we break down smarter mortgage options for borrowers who do not fit the traditional lending box. I'm Jason Nichols, your host and CMO at Truss Financial Group.
And I'm Jeff Miller, CEO of Truss Financial Group, ranked by Scotsman Guide among the top 10 mortgage brokers by volume. From HELOCs and DSCR loans to financing for self-employed borrowers to senior homeowners, we cover everything that matters for our audience.
Let's get into today's topic. Jeff, today we are introducing something that a lot of real estate investors do not even know exists, the DSCR HELOC.
It is a product that combines two things we have talked about extensively on this podcast, the flexibility of a HELOC and the investor-friendly qualification structure of a DSCR loan. And for the right investor, it is honestly one of the most powerful tools available right now. And the reason most investors do not know about it is that most lenders do not offer it. It is a more sophisticated product that requires a lender who genuinely understands both the HELOC structure and DSCR underwriting at the same time. And that combination is not common.
Jeff, so today we are breaking down exactly what it is, how it works, who it is built for, and why it opens up loan eligibility in a way that traditional products simply cannot.
This is one of those episodes where investors are going to finish listening and immediately think about which property in their portfolio they should be applying this to.
Let's get into it. Jeff, let's start from the ground up. Could take a moment to explain what exactly is a DSCR HELOC and how does it differ from a standard HELOC?
A standard HELOC qualifies you based on your personal income. The lender looks at your tax returns, your W-2s, or your bank statements depending on the program, and calculates your debt-to-income ratio to determine how much you can borrow. Your personal financial profile drives the qualification.
And a DSCR HELOC is different.
Yes, fundamentally different. A DSCR HELOC qualifies based on the income the property generates, not your personal income. Just like a DSCR purchase or refinance loan looks at whether the rent covers the mortgage, a DSCR HELOC looks at whether the rental income from the property supports the combined debt load of the existing mortgage plus the new HELOC.
So your personal tax returns, your W-2s, your self-employment documentation, none of that is the primary qualifier.
None of it. The property's income is the qualifier. And for a real estate investor who has a complex personal income picture, write-offs, multiple business interests, variable income, this is a completely different path to accessing the equity locked inside their investment properties.
Let's make sure people understand why this is significant. What is the alternative for an investor who wants to access equity in a rental property?
The traditional alternative is a cash-out refinance or a standard HELOC on the investment property. Both of those require full personal income documentation. And as we have talked about throughout this series, a real estate investor with significant write-offs, depreciation, and complex income structures is often going to struggle to qualify based on personal income, even when the property itself is cash flowing beautifully.
So the property is performing well, but the personal income picture is getting in the way of accessing the equity.
That is the exact scenario DSCR HELOC was built to solve. The property is the asset. The property generates the income. The property should be the qualifier. And with a DSCR HELOC, it is.
How does the qualification calculation actually work?
It works the same way as a DSCR purchase loan. The lender takes the monthly rental income the property generates and divides it by the total monthly debt obligation on the property, which now includes both the existing mortgage payment and the proposed HELOC payment. That ratio needs to hit a minimum threshold, typically 1.0 or above, for the loan to qualify.
So the investor needs the rent to cover both the existing mortgage and the new HELOC payment combined.
Correct. And that is the key underwriting question. Does the property generate enough income to support the additional debt load the HELOC creates? If yes, the investor can access the equity. If not, either the property needs stronger rent or the HELOC amount needs to be sized differently.
Jeff, let's talk about why this product specifically opens up loan eligibility in a way that other products cannot, because I think this is where investors are really going to sit up and pay attention.
The core reason is that it removes the personal income barrier entirely. And for a real estate investor, that barrier is often the single biggest obstacle between them and their equity.
Walk us through a specific scenario.
Sure. Let's say an investor owns a rental property worth $600,000. They owe $300,000 on the mortgage, so they have $300,000 in equity sitting in that property. The property rents for $4,500 a month. The mortgage payment is $2,200 a month.
So the property is cash flowing well.
Yes, strongly. Now this investor wants to open a HELOC against that property to fund the down payment on their next acquisition. They go to a traditional lender. The lender asks for their personal tax returns. After depreciation on their portfolio and business write-offs, their personal income looks much lower than their actual cash flow. The lender either denies them or offers a much smaller HELOC than the equity in the property should support.
So the property's strength is being overshadowed by the personal income picture.
Completely overshadowed. Now take the same investor to a DSCR HELOC program. The lender looks at the property. Rent is $4,500. Existing mortgage is $2,200. They open a HELOC with a payment of, let's say, $800 a month at the draw amount the investor needs. Total debt on the property is now $3,000. Divide $4,500 by $3,000 and you get a DSCR of 1.5. That is a very strong ratio. The loan qualifies based entirely on the property's income.
The investor's personal tax returns never even entered the conversation.
Never entered it. And that investor just unlocked a significant line of credit to fund their next deal without touching their personal income documentation at all.
That is a genuinely different outcome than what the traditional route would have produced.
Night and day. And multiply that across a portfolio of 5 or 10 properties, and you start to see how this product changes the growth trajectory for a serious investor. Every property with strong rental income and available equity becomes a potential source of capital, without the personal income bottleneck limiting what they can access.
What types of properties qualify for a DSCR HELOC?
Single-family rentals are the most straightforward. Small, multi-unit properties, duplexes, triplexes, fourplexes can also work. The property needs to be an investment property, not a primary residence. And it needs to have a documented rental income history or a strong market rent appraisal if it is between tenants.
Let's talk about strategy. How should a smart investor be thinking about using a DSCR HELOC within their overall portfolio approach?
The most powerful use case is exactly what we described, using the equity in an existing performing property to fund the acquisition of the next property. You are essentially making your portfolio self-funding. Property A generates equity. You use that equity via a DSCR HELOC to fund the down payment on property B. Property B generates income. Over time, it generates equity. And eventually, you can use that equity to fund property C.
So the portfolio compounds on itself.
That is exactly how serious real estate wealth is built. Not by saving up for every down payment from scratch, but by recycling equity from performing assets into new acquisitions. And the DSCR HELOC is the mechanism that makes that recycling possible without triggering a full cash-out refinance on the existing property.
Which preserves the existing mortgage rate.
Which is critical right now. If an investor locked in a 3.5% rate on that rental property 2 years ago, they absolutely do not want to refinance it at today's rates just to access equity. A DSCR HELOC sits on top of the existing mortgage and leaves it completely untouched.
So they keep the low rate and access the equity.
Both. And at Truss Financial Group, our no appraisal option for qualifying profiles means the process is faster and less intrusive than a traditional home equity product. No appraiser walking through a tenant-occupied property. No long wait, just fast access to the equity the property has earned.
Which for an investor who moves quickly on opportunities is not a small thing.
Speed is money in real estate investing. A deal that closes in 2 weeks beats one that takes 2 months every single time.
This is exactly the kind of product conversation that investors need to be having. Let's wrap it up. For an investor who owns rental properties with equity and has been frustrated by the personal income barrier when trying to access that equity, what is the first step?
Look at your strongest performing rental property, the one with the best rent to mortgage ratio. Calculate what the DSCR looks like if you add a HELOC payment to the existing mortgage. If that combined ratio is at or above 1.0, you have a conversation worth having. And if you want someone to run those numbers with you and tell you exactly what you could access,
contact us at Truss Financial Group.
We specialize in DSCR products, and we can walk through your portfolio with you to identify which properties have the strongest case for a DSCR HELOC. No hard credit pull and no pressure.
That is the move. Thanks for tuning in to the Truss Financial Podcast. If this opened up a new strategy for your real estate portfolio, subscribe so you never miss an episode. We will see you on the next one.